On this segment of the program, we're going to talk about the nuances between return on investment versus return of investment. And for that, we're joined by one of our fellow certified financial fiduciaries at Nelson Financial Planning, Rob Field. Welcome on into the program.
Good morning, Joel. Always glad to get a chance to join the show, share some insights with our listeners.
Direct from the Nelson Financial Planning Studios. For those of you who have not been to the office of late, when we did our addition here on the building, we also added in a little studio, so it's kind of easy to do this. It's all just right here on the home base. The other thing that I wanted to just mention briefly before we started on the conversation about return of investment versus return on investment is you and I as well, along with the rest of the team, are certified financial fiduciaries. And so one of the things that makes that credential unique is that that credential comes with it the highest fiduciary standard in the industry. But one of the things that also makes certified financial fiduciaries unique is it actually just recently became, and I'm sure you saw this as well, because they were sending out a lot of information on this, or the organization was, it also just recently became one of 11 financial designations in the country to obtain a sort of a third-party accreditation. So I thought that was kind of neat to be able to see that with that certified financial fiduciary designation, which is a relatively new designation out there.
Correct. We were one of the first offices to really decide everybody in the office would be a certified financial fiduciary. That we saw that fiduciary phrase tossed around a lot, and in general terms, that means I'm going to be responsible for you, and I'm going to do what would be good for you. But the certified financial fiduciary designation holds us accountable to the fact that we're going to do what's in their best interest. That's because right. You could certainly say, well, this investment or this idea is suitable for you. That could work, but everything that we are presenting is actually what is the absolute best interest of our clients. And we're held to a standard that we must do that with that designation.
Right, and it's the highest standard in the industry. And great to see that it has now become one of only 11. I mean, there's an alphabet soup of stuff out there. Financial planner, financial advisor. I mean, just a complete soup out there, which in our view has led to a lot of confusion in the overall investing public. But certainly great to see that there's this particular credential now been fully accredited, and one of the very, very, very few. So anyway, so we digress on that. A lot of people are asking this question. A lot of people are getting hung up on sort of what the return of investment means versus the return on investment. We see that particularly with increased conversations about CD rates, money market rates, and things like that.
Right, and annuities also. That's where there's really a big difference when you talk about that. And as you mentioned, I'm getting a lot of phone calls from clients and prospects who want to talk about investments that involve interest rates. The stock market being down last year has a few people scared, maybe sitting on the sideline. Interest rates have gone up, and as they go up, sure, it's costing you more money to borrow, but people are really noticing the difference on what their bank CD might be offering or what is a money or market rate paying. And the numbers are becoming so competitive that people are considering moving out of equities for a period of time and over into something that has that higher interest rate. So as I get those phone calls, I start to pick up on some themes where people are confused about what the interest rate really means versus, how much am I really going to get? What is my return versus what is the yield? And the conversation comes up a lot about, am I getting the money that is being sent to me? Is it my own money coming back, or am I actually earning money? Am I getting a yield? Am I getting a return? And so because of these conversations, I wanted to jump in on a segment and just kind of clear up a couple things that I had seen. I think the thing that pops out the most is interest rates on bank CDs.
Right.
So I'll see somebody will call me and say, I know you're telling me that your money market is in a certain range, but I was just told by my banker that they have a CD, 3-month CD, it's going to pay me 4%. And they think that's 3 months from now they will get a 4% return. And if you annualize that, the bank's not paying 16%. Right. But it's
well, no, let's hope we never get to that environment where we see CDs at 16%.
I was when I was younger, just going into college, and Jimmy Carter was president, that you were borrowing money in the high teens, but your CDs were paying in the high teens, and everybody was happy with it.
Yes. Unfortunately, inflation was relatively high then as well.
Very much so.
Which is one of those things that I think people need to remember is great. I can get 4.5% on a money market or a CD or whatever the case may be. But if inflation's still at 6, well, then I'm not making anything at the end of the day.
We go back to purchasing power. You could throw your money into something that earns 2-3% and think, okay, I'm safe, I'm getting growth. And then we had a client yesterday who said to us, I'm doing all these things and I have all this money invested, and yet it seems like I have less money because I go out to buy things and it costs more. And so as great as 4.5 on a money market, and that is available, sounds, when inflation's higher than that, at the end of the day, you feel the pain.
Yeah, reduction in purchase power, that is for sure. And so when people see those rates, they think that is what they're going to get on a 3-month or maybe a 9-month, but that's the annual rate. That's not actually what you're going to get back in terms of your profit.
Correct. That's not your that's a return. Sure, you're going to get 1% technically every 3 months, and if you kept buying the same CD 4 times in a row, then you hit your annual number of about 4%, maybe even a little bit of compounding. But the 3-month CD is not paying you 4% at the end of 3 months, but it's an attractive number. It's catching people's interest. The money market numbers that we talk about, they're always an annualized. And that's why the CD number comes out at 4%. It's trying to tell you what an annualized number is so you can compare apples to apples. What's the return of this? What's the yield on a money market? What is the stated rate of return on a certain investment? They always try to talk in annual numbers, but it can be confusing if you don't realize that number they're telling you is an annual number, not the 3-month, the 6-month, or the 9-month.
Well, and that's where this concept of return on investment versus return of investment really, really requires a moment to sort of understand that, because oftentimes you'll hear, particularly on the annuity side, where there's percentages. It's, oh, you're going to get 7%, you're going to get 8%, but that's not the return on the investment. The return on an investment, folks need to think of okay, what's my profit here?
Correct.
I mean, that's the best way to think about that versus return of investment. Well, wait a minute, that's not, I'm not making money on that. If you're just giving me money back, that is the return of my investment. That's just getting me back what I already put in.
Correct. When we talk to our clients about generating income, we try to talk in numbers as in, let's not hit your principal if at all possible. Let's generate an income off of your investment that would go above and beyond the value. And so we talk in that 4% range, which is conservative. But if you can stick at income of 4% of whatever your investment is, if the markets are averaging 5, 6, 7, maybe get up into the 8s, you're in good shape. To make it competitive, though, we get the same phone calls from somebody saying, well, you're telling me 4, my annuity company says they'll pay me 8, 7.5%. So why can they pay out more than you? And the case is what you were just describing, and that is they're just giving your own money back. Our goal and our job, especially as a fiduciary, is to have your investments grow, maintain their value, or grow, generate some income somewhere down the road. An annuity's job is to simply take a lump sum of money and over a period of time pay it all back to you with maybe a small amount of growth. And I say that small amount of growth because when we break down the actual internal rate of return on an annuity, not the 8% that they're throwing you that your own money back, but just the growth portion internally of the annuity, it's in the 2% range.
Right.
So if you lose all control,
which is your return
of an investment.
That's right. Exactly right. So if my return of the investment is, or the return on investments, it's easy to get confused on what means what, but
sure.
the actual return on my investment is only 2-3%. That's not going to allow me to get much growth, because when we talk about the concept of compounding and growing money over time, that relates to the return on investment. And in terms of ultimately getting growth. We're going to take a break and continue on with this conversation here on Dollars and Cents with Joel Garris and Rob Field of Nelson Financial Planning after these messages.